So I'm planning to spend the first few minutes of the presentation to explain our approach to investing in Asia ex-Japan. Then I'll go on and discuss our view on the region and how the trust is positioned as a result of those views. So as a team, our aim is to outperform the market significantly over the medium term. And in order to achieve this, our key focus is on investing in companies that we believe are worth more than the market believes. And this puts valuation at the heart of our investment process. This chart shows the relationship between a company's fair value through time and its share price. And as you can see, the share price is much more volatile than the underlying value. And this happens because the fundamentals of all companies shift over time, sometimes for the positive and sometimes for the negative. And in our view, the market tends to extrapolate these shifts into the future, leading to periods of over and undervaluation, and this is a source of opportunity. So our investment process is built around trying to identify and invest in companies that are trading at a significant discount to our estimate of their fair value, and to sell when they reach their fair value. In order to do this, there are a few key elements of the process. Firstly, we often look in unloved parts of the market for new ideas. And when we find a candidate, we spend considerable effort to get a deep understanding of the business and to try and understand why the market might be wrong and why the price might be wrong. This requires an ability to think long term and considers downside risk as well as upside risk. And finally, it often requires courage really to move against mainstream thinking. So hopefully to bring this slightly to life, I'm going to talk you through an investment that we've made in Mediatek, which will hopefully illustrate the process in practice. So you can see the share price chart of Mediatek, and the shaded blue part of the chart is the shareholding of the investment trust in Mediatek. So Mediatek is a company that designs silicon chips that go into consumer electronics products. They started off in DVD players and gradually ended up making chips that go into smartphones and products like the Amazon Echo, for example. It's a company that has a history of growth and of strong profitability because they've always successfully managed to transition to new product cycles as existing ones matured. It's also a very cash generative business with impressive free cash flow generated for every year, I think, in the last 20. However, as you can see from the chart, by 2017, the stock had fallen on quite hard times, had fallen about 50% from its high. And I would say this is a very typical kind of share price chart at this point of a potential new idea on our team. The problem for Mediatek that it had underestimated the speed of transition from 3G smartphones to 4G, and their products just weren't mature. And so they got low prices and they had a high manufacturing cost. So that was a double hit to their margins. And what got us interested initially in this company was that actually at the low point, it had almost 50% of its market cap in cash, and it was trading on a low teens multiple on margins that were quite well below historical levels. Our research told us that this was primarily a timing issue because they had new product launches coming at the end of 2017, rather than something more fundamental about Mediatek's competitiveness. So the investment case here was built around the idea that earnings growth would actually end up being much better than the market thought, and that there was strong downside support from the cash balance and the low multiple on normalized earnings. And the focus on the long term here, rather than short-term earnings weakness, was really important. And you can also see the sell discipline at play here. So, fast forward to today, Mediatek's share price has risen very substantially, and you can see now, in our view, getting close to fair value. So you can see our shareholding has been coming down. Hopefully that intro into our investment philosophy will give some context as we move on and talk about our view on the outlook for Asia. And here I'm talking about Asia ex-Japan. As you can see from the chart and from Russ's presentation, Asia has already performed very well, and it's actually up 30% on the level prior to the outbreak of COVID. So it seems rather miraculous given where we were 10 or 11 months ago. Asia has also outperformed US equities and European equities as well over this period. I think there are a few reasons why. As Russ pointed out, Asia has generally managed COVID better on average, and that's led to a lower economic and earnings impact, particularly in places like Korea and Taiwan and Korea. But actually, even in countries that had a bad COVID, like India, for example, the economic recovery has been relatively fast, and in the case of India, kind of the economy is now back to normal, really. I think really importantly, the damage to banking systems has been much smaller than we might have thought earlier on last year. But there's another important reason, I think, like the US, the internet and tech sectors are very well represented in Asia ex-Japan. These are companies that have really benefited from all of the COVID-related impacts of working from home, consuming, studying from home, and this has led to an acceleration in earnings and a re-rating for these sectors. This chart shows the returns by sector. I think Russ showed a chart for country by country, and I think at the moment, in a way, the sector picture is a bit more instructive. You can see that returns have been dominated by those COVID beneficiaries on the left-hand side, and there's an unusually wide disparity of sectoral performance. A number of the more COVID impacted and more economically sensitive sectors, while rebounding from the lows, gave small or negative returns over last year. And this gets lost if you just focus on the overall index. Turning to valuation, the region is trading on over 2 times trailing price to book value. And I guess this may be one area where my view begins to deviate from Russ. At the index level, this chart does make us feel quite cautious. I mean, we're using price to book here because it helps to iron out the earnings distortion caused by the recession we've had. As you can see from the chart, Asia ex-Japan has not managed to sustain this valuation level for very long, historically at least. But I think this is mitigated to some degree by the change in the makeup of the index over time. In particular, tech hardware, internet businesses represent nearly half the market today, whereas 10 years ago, they were roughly 15%. So some of these, particularly in the internet area, are quite asset-light businesses, and this naturally biases up the price to book of the market. However, what I'd like you to note from this chart, and here, the pink dots are the current valuation, the blue bars are the 10-year average valuation. What I'd like you to note is the degree to which these same sectors on the left have been re-rated, and in many cases at a significant premium to their average valuations. This shows that there's more going on here than just a change in index composition. Conversely, on the right-hand side, there are a number of sectors that are trading at or below 10-year averages. Many of these are admittedly in quite unfashionable areas of the market, but it demonstrates that blanket statements about market valuation, I think, miss the full picture. So where does this leave us in terms of the outlook for Asia at the index level? Well, this chart just shows the returns that you would have been made had you bought at different valuation levels historically, and this goes all the way back to 1995. So you can see that buying at this 2 times price to book level has generally not been very rewarding at the market level. There are mitigating factors, as I've said, the change in market composition, but I think also importantly the wide disparity of valuation at the moment within the market. So as active managers, fortunately, we don't need to buy the index, and we can take advantage of these valuation differences. For example, our own company shortlist that we use to compare implied returns for stocks in our own portfolio has an average IRR implied of 10% per annum over 3 years, so substantially better. But for this strategy to work, we definitely need a different and broader market dynamic than we've seen in recent years. And to us, the most likely catalyst for this to happen is a more abundant earnings environment, and that's likely to result from better global growth and certainly stronger growth than the anemic growth that we've seen in much of the post-global financial crisis era. So is this likely in 21 or 22? Well, to us, there's a decent chance, and this goes beyond the mechanical rebound in, for example, in the contact services industries that will happen as vaccines become widely available. There really is very significant policy support for spending, especially in the developed world. And this reminds me a lot of what we saw in China after the global financial crisis, which at that point, China was the center of global reflation. So firstly here, as you can see in the chart, the transmission of monetary policy has been much more effective this time around than in earlier episodes of QE. So for example, deposit growth in the US, shown here by M2, this is growing at the fastest rate since the Second World War, and we estimate that we're going to get another 12% growth this year, just based on committed QE and various fiscal programs. So to quote our chief economist John Greenwood, it's money in the hands of the public that matters, and that's the deposit part, and and it's growing much faster than it was earlier on in the last decade. The US is the strongest example of this, but you see a similar pattern of higher money growth repeated in other parts of the developed world. And this looks at the same thing through the prism of fiscal policy, and I think it shows why spending ought to be quite strong as we move ahead. In the US, for example, fiscal transfers have meant that even before this new package that's currently being discussed, personal incomes are higher on average than they would have been had COVID never happened, which seems strange to say. And mobility restrictions have meant that a lot of that money hasn't been spent, and there's somewhere in the order of 1.4 trillion of excess savings there, or 7% of GDP that could be spent. The policy stimulus in Asia, while supportive, has been quite pedestrian by comparison to the US. But I think, as this chart shows, the correlation between Asian exports and earnings revisions show that global demand remains a really important catalyst for growth in Asia. And when you look into the details of the current strength in earnings, it does seem to be supportive of this idea of market broadening that I've been talking about. So currently, I think 13 out of 16 of the 16 sectors in the region are experiencing net upgrades, and this compares to only 7 on average during historic earnings upturn periods. So there's a distinct broadening going on. I do think that the more conservative nature of the policy response in Asia is a plus point for Asian equities relative to other regions. Again, I'm reminded of China's struggles with the subsequent fallout of their aggressive stimulus post the global financial crisis, where they had to deal with excess capacity and large increases in debt levels. I think by comparison, when we survey Asian economic fundamentals today, across credit, money, external deficits, government debt, there are very few red flags that we see. And as Russ pointed out, Asia's valuations still look pretty reasonable on a relative basis, particularly compared to the US. Now, just moving on, I'd like to spend a few minutes talking about how the Vasco Asia Trust is positioned currently. There's a lot of data on this slide, but on the left-hand side, you can see how it's currently positioned relative to the index by sector. But I particularly like to focus on the green boxes on the right-hand side, which just shows how our weights our active weights versus the index have changed over the last 6 months, because I think that's illustrative of what we've been changing within the portfolio. So I think the first thing to note is the reductions that we've made, not only in the IT sector, but also in consumer discretionary and consumer services, which is where most of the internet businesses in Asia sit. These are coming from historic overweight positions. And I think in the case of IT or tech hardware, at one point we were, I think, seven percentage points higher than the index in that sector, just to give you an example of where we've come from. And these changes shouldn't be, I suppose, much of a surprise given what I've been saying earlier in the presentation about valuation. And it really just reflects the fact that several of our holdings have breached our estimates of fair value, and we've been either reducing or exiting some of these holdings. And this, this snapshot was taken at the end of February, and given markets are moving so fast at the moment, we've made further reductions in February. So what have we done with the proceeds of these sales? Well, the main changes have been, firstly, to reduce the gearing within the trust. We had been, I think, back in February, we peaked at something like February of 2020. We peaked at something like 8% gearing, and today we're at a small net cash position in the trust. And so this reflects our policy of using market valuation as a guide to the gearing level of the trust, and a dynamic gearing policy. We've begun to add exposure to the real estate sector, where previously we had no weighting at all. As you'd know, property has been one of the sectors most impacted by COVID. Empty office space, offices, shopping malls, have been a key fallout of COVID-19. But we do think there's been a very broad derating of this sector, which has created some opportunities. Finally, we've increased our exposure to financials. More recently, this was actually the sector that we took quite significant action on right at the beginning of the pandemic, because we felt there was greatest risk or greatest uncertainty over how to value these companies at that point. But as we've gained confidence in this sector, we've begun to add back again. In particular, Indian banks, which I think are structurally the most interesting story in Asian financials, and COVID-19 and all the uncertainty that brought gave us an opportunity to buy some of the better quality private banks in India at quite low valuations. And more recently, we've added to some more rate sensitive exposure. And really, we've been looking at banks and insurance companies that are pricing in the idea that rates are going to stay low forever. And we've added to both banks and general insurance companies. And I think insurance is quite interesting at the moment, because there's also a hardening cycle of the insurance rates playing out globally at the moment as well. So this results in a portfolio that has a lower valuation than the market, both on a PE and a price to book level, and a higher dividend yield and free cash flow yield than the market, and modestly lower earnings growth. I'd also point out that the portfolio has very low exposure to indebted companies, and this is part of our focus on quality or balance sheet quality and potential downside risk. So only 18% of the portfolio has exposure to companies that have any debt at all. I'd like to finish off with just a few quick stock examples. And these are areas where we still see significant undervaluation in the region. One of the features of the last 12 months, which I can't completely explain, has been a widening of conglomerate discounts in Asia. And one extreme example of that is LG Corp in Korea. This is a debt-free parent company of the LG Group. And here, actually, the underlying subsidiaries are of very high quality. You've got LG Chemical, which is one of the leading electric vehicle battery manufacturers, LG H&H, which owns some of the top cosmetic brands in China, and LG Electronics, which houses the group's consumer electronics business. And here it's finally jettisoning its mobile division, which has been making large losses and hurting the profitability of the company. But overall, we think that LG Corp is trading at something like a 75% discount to the market value of its assets. Next, the bulk shipping sector. This is a very cyclical sector, but one that has endured a very long down cycle thanks to the hubris that happened at the end of the noughties in 2006 and 2007, when something like 50% of the existing fleet was on order. So a huge increase in supply. The industry has struggled with profitability for years as a result of this. And this is reflected in the weak share price performance of Pacific Basin here, which we think is one of the better managed companies in the sector, and that's shown in pink on this chart. Coming to today, the undelivered order book has now fallen from that 50% to closer to 4% or just below 4%. So you can see that demand is finally catching up with supply, and this very recently has started to be reflected in an unseasonal spike in shipping rates, which is shown in the blue line. And we think that the market is really underestimating the long-term earnings power of this business. It's been through many years of marginal profitability, but we think there's a good chance that over the next few years we'll get an upcycle in profitability, and that's not priced in. And finally, Chinese property, probably one of the most out-of-favored sectors in the region. The reason for that is that the Chinese government have made it pretty clear that it wants to resist increases in property prices, and as a result, it's starving the most indebted property developers in China of credit, and it's forcing them to lower debt and meet certain leverage limits that it's set. But this is a huge market, and so I think this will create opportunities for companies that have balance sheets that are in good shape, like China Overseas Land here. And this will allow the better quality companies to gain market share and essentially grow at a faster rate than is implied by the current low, only 4x PE valuation. So despite China Overseas Land's better quality, it hasn't escaped a very significant derating. So to sum up, these are the key thoughts I'd like to leave you with. Firstly, at the headline level, the market is beginning to look a bit expensive. But fortunately, we don't need to buy the index and are able to take advantage of the valuation disparity across sectors. And this is reflected in the lower valuation of our portfolio versus the market. Finally, we think that these wide valuation gaps that we're seeing are becoming less justifiable given the breadth of the earnings recovery that we're now starting to see. And with that, I will hand back to Russ.